Welcome to the AZ Tech Podcast. I'm your host, Hamid Shojaee. Let's go. And we're live with Todd Belfer, who's a managing partner at Canal Partners, who's been a major investor and highly successful one in Arizona with successes like WebPT and NetTime Solutions, Limos.com, numerous others. Hey, Todd.
Hi, Hamid. Thanks for having me. I'm excited to be here.
Awesome. Thank you for agreeing to do it, especially on such short notice as well. I appreciate that. So what'd you think of the intro music before I get started?
I liked it. I was like getting ready to start, playing air bass. I enjoyed it.
I love it. That's awesome. So you and I have known each other for 26 years, which is kind of crazy when you think about like how long ago I met you actually, and you were crazy enough to invest in my first startup.
I think you were like 9 years old
Yeah.
when I invested in you.
Thank you for that. Yeah. But, maturity-wise, that probably wasn't much more mature than that. So, when we met, you had just exited Employee Solutions.
So 1996 probably.
Yeah, that sounds about right. End of 95, early 96.
Yeah.
So tell me about Employee Solutions. That's sort of where things started. There's so much I want to talk to you about, but that seems like a good place for us to start.
Yeah, that was kind of like the second thing I ever did out of college was Employee Solutions, and it was a company I started with my dad. We both didn't know what we were doing at all, but it was a referral from a friend of my dad's who was a tax attorney in town, and we started this thinking that originally employee leasing and the PEO space was based off of a tax loophole from 1986. Where you could put away a lot of money for the owners of a business into a defined benefit pension plan or profit sharing plan and exclude ancillary employees and set up a separate profit sharing plan for them that has an equal benefit. So really, business owners, mostly doctors, lawyers, and professionals, did it in a way that they can sock away a lot of money in retirement plans.
Right.
And employee leasing became the avenue for that. They changed that law and it closed, but everyone saw the benefit of outsourcing their HR and payroll once that occurred. And so everyone's like, even though the tax advantage of doing a profit sharing plan is gone, there's still a benefit of outsourcing payroll and HR functions. So the business kind of was born out of that in the late 80s, early 90s, and then we started Employee Solutions. It was funny. I knew I was coming on here last night, and I was thinking when we came up with the name Employee Solutions, and we were actually at our tennis club, and my dad liked the name Employer Solutions, and I liked the name Employee Solutions, and I guess I won out because that was the name. But, we really had this drive to become this outsourced payroll company that offered benefits and workers' comp and recruiting and employee handbooks and all the kind of the HR functionality to a small business and at affordable price.
Yeah.
So
and it was literally the high-flying success story of the 90s. And it was a publicly traded company at one point, which was enormously successful. You had your exit, and then you went on to sort of like invest in a lot of different types of companies in Arizona. And that's where I want to really focus on because that's not normal for people to have their exits and then take their money and start investing in, high-risk companies like mine at the time, which, we might get into, hopefully not. But
come on,
but
Vitrix.
but normally, people take their winnings and they sort of, they go to something super low risk or real estate or something like that. And you went on to invest in both, tech companies, but also, if I remember correctly, you started a restaurant at about the same time that you invested in Vitrix, which was like 96 timeframe. And that restaurant ended up morphing to something else. So let's talk. Was it Zanzibar, the first edition of it?
Great memory. Yeah, it was Zanzibar. So I left Employee Solutions in March of 1996. And I left the board and I sold my stock. And in 95, 96, I invested with some college buddies in a restaurant called Zanzibar. And we hired a chef from Wolfgang Puck out of Beverly Hills. He came out, did this fancy menu and white tablecloth, high-end Mediterranean Italian type food. And after I was putting money in almost monthly to keep it afloat, after 8 or 9 months, I said, that's enough. I'm not doing it anymore. I'm not putting any more money in. And that's when I was going to either sell the lease and the restaurant just to recoup some of my investment or come up with a new concept. And we went out and got drinks one night. We went to Kyoto's and we said, we got pretty drunk and we said, let's come up with a rock and roll sushi concept.
Nice.
And we said, let's start something. And we raised $100,000, mostly my own money. And we converted it from Zanzibar to Raw that summer. And
Raw being the sushi restaurant
Right.
that became highly successful, right? Like, what is there? Like, there's a bunch of locations now.
Well, there was 30. They might have closed a few in the last couple of years, but there was 30 a couple of years ago.
That's awesome. So it turned to be a success story. I mean, this is what I love about your investment strategies, that you've been extremely patient. Even when I left my company, you stuck with it and like eventually had a successful outcome and exit. Whereas, I gave up after 5 years. I was like, F this, I'm out.
And I don't know if it's just because I'm not that smart or I just, can't take a loss. My ego won't let me take a loss. But I was looking at Vitrix, which was then Time America, then NetTime. It was actually 18 and a half years from the time I actually invested to the time I exited. And I'm like,
crazy.
That's like the majority of my, working career.
and at least 14 years of those 18, you thought it was completely lost, right?
I mean,
how many
pretty
years
much
did
every year.
Every year, like up
every
until
year,
the sale.
This is it. We're going to shut the doors, every year. And it's just, you hear it from like Mark Cuban and a bunch of people. It's like, you can't give up. You just can't give up. You got to figure out a way. You got to figure out a way. And thank God, your co-founder, Behan, didn't give up on me. Because if he would have given up, it would have been over for sure.
Yeah. I commend him as well. Every now and then, Behan and I meet up for lunch or whatever. And, we've talked about how, I can't believe he stuck it through, I mean, I gave up, I think, in 2001 timeframe. And he went all the way to the end, which was what, 2014, 15 you guys sold?
Well, it's been like 5-6 years. So, probably about that. Yeah.
Yeah. And it's kind of incredible, that journey from start to exit. You never know what paths it's going to take you. And, during the time I was there, the first 4 or 5 years, it felt like we were about to close doors multiple times. And I finally gave up after 5 years, left, went, did other things. But you guys kept going. And at one time, as I was sort of barely paying attention, it seemed like the company had a ton of debt and, it restructured several times. And, take us through some of that journey. What are some of the sort of ups and downs that you've had in these investments? What has been the most interesting one? And we don't have to necessarily talk about Vitrix that ended in NetTime Solutions, but whichever one has been interesting. If Raw is more interesting.
Yeah, for me, it's where there's chaos and complete pain, there's opportunity.
Okay.
So
that's a good way to look at it. Chaos and extreme pain.
Yeah.
Within the company or within the marketplace or both?
It's actually within life too. Like in my personal life, whenever I'm in a valley of pain, I know something good's going to come out of it, and that's my faith. But in business too, when there's extreme pain and you're in that valley and you're like, I don't know how I'm going to get out of this. We are in big trouble, there's an opportunity, there's a way out, there's a door out. And sometimes the door out is shutting the doors. Other times it's making some hard moves and kind of retooling the company for success. And in the case of Raw, I remember one of my partners was like, no, let's just shut it down. Didn't work.
The Zanzibar before you guys.
Yeah, Zanzibar.
Yeah.
And then, again, that's like that no quit attitude I have. We're at Kyoto's having drinks. I'm like, no, we're going to do this. We're going to do this. I'll put up the 100,000 to convert it from Zanzibar to Raw. And, those two guys got on board, my two partners there. And, it turned into a success story. But it's really easy to let fear and panic and anxiety get a hold of you and just like, no, it didn't work. Let's get out. We lost a lot of money. We had to fire all the employees. We got a dark restaurant now. Let's just go home. Let's just sell the lease, which would have been a normal, pragmatic solution, by the way.
Right. It's funny. I was just talking to Bob about that fear factor as well, because like there's a point at which you got to get over the fear of failure and say, it doesn't really matter. Whatever happens, happens. We're going to just dive in and do it. And I feel like amazing things can only happen after you get over the fear factor, right? Like, so with Raw, that transition from Zanzibar to Raw, was it an immediate success once Raw started, or did that also have its own set of challenges? And how did you go from one restaurant to 2 restaurants and then 3 restaurants? And eventually that was also an exited sale, right?
Right. We sold it to Benihana right after 9/11, actually. We sold it to Benihana when we had 4 stores and another one that was going to open in Tucson, was our 5th. And it wasn't a straight line up by any means. So we opened Scottsdale, and it was doing okay. It was profitable.
Right.
It was doing okay. We could pay the bills. We could make the payroll. We weren't losing money. We weren't doing capital calls every month. But then we opened a second one in Tempe on Mill Avenue, and that one was losing money from day one. So from day one, we're losing money in Tempe, and it was like, deja vu all over again.
Right.
First one's making money, second one's losing money. And we were doing capital calls, and we were writing capital calls. Same situation. My partner's like, no, let's just close it down. I'm like, no, let's just do one more capital call. Let's just change our sign. Let's just change the hours. Let's advertise in the new times. Let's try something new. And we just stuck it out. And eventually, like 1 month, we're like, holy cow, we didn't put money in. Like,
that's awesome.
We didn't have to feed it. And then another month went by, and we're like, hey, we made $1,000. And like, and eventually Raw Tempe became a very successful restaurant and was making, well over $1 million a year in its heyday. And, the first year it was painful. We were in the valley. We were in trouble. We were in panic. We should just shut the doors. We should just close it. But sometimes things just need to breathe.
Right.
Sometimes you just need to let it happen and not rush it. Restaurants, I find, take 4, 5, 6 years before you hit peak performance as far as people knowing about it, getting enough customers in to support it, getting the right staff. It takes time.
So here's what is absolutely most impressive. And I don't know if many people know this about you or Canal Partners in general, but like you've had success in restaurants and you've had success in tech and possibly others, which I may not know about. So I want to talk about that if there are any. But it's not just a fluke where you've had one successful restaurant, one successful tech. You've had multiple of each. So in tech, you've had NetTime Solutions that you stuck it through, but then you went on and invested in WebPT and Limos.com. And, like maybe you can tell us about some of the others as well. And maybe some of the failures so I can feel better that, Todd's not just hitting, batting home runs.
Yeah, no, there's definitely been some strikeouts. And those are the ones, by the way, where I learned the most about myself and about how to do business, for sure, on the failures. The successes, a lot of times, it's luck and being in the right place at the right time and betting on the right jockey, for sure. Betting on the right jockey.
The founders, essentially, in this case. Yeah.
The ones I've lost, typically, it's not necessarily the space we picked. It's more we picked the wrong jockey.
Okay.
And we didn't know that till after we were in and already on the board and an investor and a shareholder, and we were knee deep in it. But I would say some of the successes you named, NetTime, WebPT, CallRail, Pet Desk, Allbound's turning out to be a big success for us that we haven't exited yet, but we've kind of crossed that mark where we're not concerned about losing our capital. But the ones that went to zero that I learned a lot about myself, our firm, and kind of where we have tripped, one was called Mobile Logics, which then changed its name to Agile Field.
Okay.
So great space, field service management space, space is blowing up, getting a lot of venture dollars. And we ended up picking a company that had incredible technical challenges from the start.
Okay.
Personnel problems from the start, big leadership problem from the start, and didn't have a completely honest, transparent CEO and founder. So
That's always tough.
Yeah, and when I come in, the first thing I say is I want the bad news first and the good news second.
Right.
And he's like, oh yeah, of course. And it turned out that there was good news first, good news second, good news third.
There was only good news.
We never got to the bad news. So
until it had to close down.
Until we had to close it down.
Yeah.
And
it's like one of those too good to be true cases where
Well, we actually asked him to step down, which he said no. And then we legally got him to step down. And then we hired a new CEO. And then after another year, we just realized that sometimes it's a money pit.
Right.
And you're better off walking away. Or it's just cheaper to start something from scratch,
Yeah.
And that case, we just shut the doors, wrote off our investment, and unfortunately had to let go of all the employees.
What do you think is the – well, first of all, let's talk a little bit about the investment criteria. You guys invest at a certain stage, right? Like now you're sort of pretty regimented about the – you no longer invest in the type of companies that I was starting in 96 or 95.
Right.
You want them to already have a certain amount of revenue. Talk about your investment criteria now.
It typically has been $1 to $3 million of annual recurring revenue.
Okay.
Because of the market has gotten so hot and so competitive, we've actually gone down to probably $500,000 of recurring revenue, and reduced our check size from $1 million of a minimum check to $500,000.
Okay.
So now it's $500,000 of annual recurring revenue, $500,000 minimum check, up to $5 million of maximum check.
Gotcha.
And $3 million of annual recurring revenue. If someone's doing $5 million of ARR,
they're probably out of
they're
the
outside
scope.
of our scope for sure.
That makes sense. And then where do you think what are the sort of categories that you guys are playing in most? Is it tech, SaaS companies specifically?
Yeah,
or?
it's mostly SaaS tech companies. I've had probably 20 term sheets in the last 2.5 years that I've submitted, and I have not won one of those term sheets. I'm 0 for 20 in the last 2.5 years.
Get out of here. That's how competitive it is.
Yes.
Okay.
And I would say I lost the majority of them on valuation.
And to who? So like outside of the state investors?
Yeah, all of them outside the state.
Okay.
I didn't lose to one from inside the state.
Yeah.
Chicago, New York, San Francisco, even debt. Like I lost a couple to debt providers.
Interesting.
Because the debt guys got so aggressive. The guy's like, well, I don't have to give up any of my company.
Right.
And I can go borrow $5 or $10 million.
Yeah.
And he's still losing money. You
Right.
know? So
now, this is a good experiment. Let's talk about that a little bit. So you've not had an opportunity to invest in 20 companies that you did want to invest in.
Right.
Did any of them like take off to a point where like you're like, damn, I should have like gone ahead and written the check for whatever?
Yeah. I haven't followed all of them, but one was Trainual that kind of got away from us.
Chris Ronzio's company. Okay.
Yeah. Full Bay, I had a term sheet on that we were getting pretty close, and then he got a term sheet from a Chicago firm for much, much higher valuation than we had.
Okay.
Which, again, I tell guys, hey, take it. If I were you, I would take it.
Right.
I don't want you to take me because I know you and we have a friendship.
Right.
And I'm local. I want you to take the best deal for you. So, for 12 years, we didn't have that problem. Because we were the only term sheet for WebPT. We were the only term sheet for PetDesk. We were the only term sheet for CallRail.
Right.
Now,
I remember Brad telling the story of WebPT that like, he was pitching to the angel groups locally ATIF and Desert Angels, and they were taking forever to like write the check. And you guys came in and you're like, here's $1 million bucks, or I don't remember what it was, but that's awesome. And you've actually been investing heavily in state, which is kind of cool. And again, most people don't necessarily know that these in-state investors exist. So this is part of the reason why it's important to highlight both the investor side as well as the founder side. But you guys being super active, it's cool that you're getting competition from outside the state. But when these companies win, in a way, the winnings also go outside the state, right? Like it's not reinvested back into Arizona. Whereas when you took money out of WebPT, you're sort of like, okay, what's the next company I can write checks for, right? So, so what do you think you have to change? Like do you have to like sort of mentally prepare yourself that okay, I got to be used to higher valuations, kind of like the stock market has kind of gone insane, and
Right.
maybe this a similar sort of thing is true on the private equity side as well.
That's what most people are doing. They're adapting to the market.
Right.
So all the other venture funds and private equity firms and funds out there are adapting to the market. Valuations are going up. The KPIs have changed. Multiples have changed. So let's play along. Everyone else is doing it.
Right.
I'm not that guy.
Okay. You're thinking that this is not going to last as like.
Well, it might last, but it's mostly my money, my family's money, and my partner's money.
Okay.
And, we do have some limited partners, but they're good family and friends too. So,
Right.
I just don't want to take a gamble on investing in something at 15 times annual recurring revenue, and I'm wrong about the market.
Right.
And I got to make a call to a bunch of investors and say, oops, I mistimed the market. We just lost half or all of our money.
Right.
I just don't, I'd rather not do a deal than have to make those calls, and time the market so imperfectly. But, we've had a straight line up for the last 6 years.
Yeah.
And we used to think, if we can get 5, 6, 7 times ARR, we're like hitting a grand slam home run. Now that's like a joke if you got 5 or 6 times, right? For something growing 100% a year, it's like you expect 10, 15, 20 times
revenue,
annual recurring revenue. And it's like, which is great for our exits.
Right.
We have 2 companies going out to market, one right now and one later in the year. That's great for the exits.
Right.
We're salivating on going out to market for these 2 companies. But trying to get in, it's very difficult. So it's relationships. I just got an accepted term sheet from a company in New York that is raising $1.3 million, $1.7 million of ARR, and we got in at a very reasonable valuation. But that was a referral from a family office that couldn't write a check that small. Their minimum was much higher. So they referred it out to us.
Right. That makes sense.
And these guys didn't want to spend any effort on fundraising. They're like, look, we're heads down. It's an ex-Google, Facebook engineer they were there 12 years at Facebook and Google, and they just want to have their heads down building their product, building their business. And they're like, we don't want to travel and do fundraising. And you seem like a nice guy.
It's a full-time job, fundraising. I mean,
Right.
I remember thinking that when I was doing an angel round for Pure Chat.
I remember you telling me that.
Yeah, I thought
lunches and dinners and
yeah, I thought I'm going to spend a couple months, raise $1.5 million, and then Pure Chat had so much traction at the time that I thought it should be a slam dunk, and 3 months into it, I had $0 in commitments, and I was like, shit, this is not going to work as a part-time thing. So I decided that I either have to forget fundraising or do it as a full-time thing for until it's closed. And it took me another 4 months working on it full-time for me to raise $1.5 million. I was blown away at how difficult it was, how many pitches I did, how many no's I received, and then it's like pulling teeth in getting the checks and everything. I mean, people wouldn't even necessarily say no, or they might say yes, and then now you have to actually get a check from them. And even that was difficult after the yes.
It is a full-time job, and it's getting to know someone. There's that level of fear and that level of distrust automatically, and then you got to build that level of trust and safeness around your investors.
Right.
And I have the same issue with people investing with me. I mean, I've talked to people for years, and they haven't written me a check, but they still want to talk, and they want to hang out, and they want to, tell me about that, and tell me about that. Oh, show me your next deal. I'm like, I will, but you haven't done the last 5 deals, so, but I'll show you the 6th one. Some people just have that fear factor where they just can't part with their money and can't imagine losing capital.
Right.
And then that's fine. It's just not for them. Venture capital investing is not for them because it is a risky
game. That's why people go into real estate afterwards, right? Well, after they have their exits.
Yeah. Right. Yeah. So it is risky, but it's like you got to have a risk tolerance. You can't be completely risk adverse and go into venture capital. There is no guarantee,
Right.
I just think it's risky money, so don't invest all your money there.
So you talked about the founders being sort of like key components of it. You're looking for companies that already are post-revenue and growing, at least $500,000 in revenue. What is the most exciting type of opportunity, right? In terms of maybe either category of company within SaaS or subcategory, I should say, or like what excites you about these companies that you invest in?
One of the things that excites me is the level of excitement and passion and commitment that the founders have.
Okay.
Like, you know, just sitting around with those guys having lunch or dinner or watching them in the office and just feeling that energy.
Yeah.
You know, it's probably like what Tampa Bay felt the other night, you know, after they win. It's just that energy. They have that like every day you walk in, even if there's problems and, you know, they're down for a day or they're like, you know, just whatever the issue is, like there's just such commitment and passion and excitement that you just don't have in normal companies. You
Right.
know? And I love that. Like that's infectious, and that's like that drives me, and I love to see it. Like I remember when CallRail was 8 employees, and we're sitting around with the guys, and you know I knew all 8 employees, and we're sitting around talking to the 2 founders and the other guys in the office, and it's just like it's just an exciting place to be. It's like you're at Six Flags Magic Mountain all day, and you just leave walking on a pink cloud.
Right.
You know, and I love it. And now the company's a couple hundred employees or more. And it's like a real company. But when you're 5, 10, 15 employees, that's my favorite part of it because ideas get floated, stuff gets done quickly, you know, for better or for worse.
Yeah.
And you don't have like all these layers of management and loopholes to jump through to get stuff done.
I want to change real quick from tech now to another restaurant that I happen to know that you were involved with, which is Sauce, right? Like, tell me, how did that come about? Because by the time Sauce came about, you were already investing more in tech and software companies. So how does one go from doing that kind of investment to being like, okay, I'm going to do another sort of investment in a restaurant?
I should have my head checked. So each of these restaurants have a story. So that one was Sam Fox and I were good friends in college.
Oh, okay.
Yeah, we were.
That helps.
We caused a lot of problems together in college. Had a lot of fun.
Okay.
But after I sold Raw, so he moved to the Valley in the mid '90s.
You got to get Sam Fox to invest in tech too. By the way, he's like done really well.
He's done really well. I don't know if he'll invest in tech or not, but he's good at real estate and hotels and restaurants. But I think, I think it was right after I sold Raw, and we were talking almost daily at the time. He said, "Hey, I want to show you this concept I'm working on called Sauce." He goes, I'm opening one right now in Tucson. He closed down an existing restaurant he had, and he put in Sauce. And he goes, let's drive down and check it out. It was this 1,200 square foot hole in the wall on Oracle and Ina. And he's like, what do you think? I'm like, oh, the pizza's amazing. It's quaint. It's cute. It's like authentic Italian, thin crust, not a lot of sauce. I mean, it was just a beautiful piece of art. And I drove down. I'm like, I love this. I think this could be great because I want to do this fast casual,
right,
and just really grow it. So,
is this before Sam Fox had all the success for restaurants?
Yeah. He had Bloom in town.
Okay,
and I think he had Bloom in town, and I don't think North quite opened yet, or maybe it did. North and Kierland opened, but that might have been it.
Okay, but he was experimenting with a smaller.
Yeah,
sort
he
of
was
restaurant.
mostly a Tucson guy at that point.
Okay,
he had most of his concepts in Tucson. So he was well known in Tucson, but he was just coming to the Valley.
Gotcha.
So he had Sauce that just opened in Tucson, and I said, yeah, I love it. So I'll give you the money for the next few.
Okay.
So then we opened 7th Street in Glendale. I joined the board of Sauce. It was really me, him, and his team. And we opened 7th in Glendale, and that worked. And then we said, okay, we got something here. And then I put in some more money, and we just grew it to 9 stores, I think.
That's
and
awesome.
then he didn't do anything with it for a long period of time.
Right.
And then he tried to sell it. No one would buy it. Or I shouldn't say no one would buy it. He didn't get the price he wanted.
Right.
And then Scott, my old partner at Raw, myself, and put together a group of investors to buy it.
Oh, okay. So do you guys still own it?
Yeah, we still own it.
Oh, I didn't know that. That's great.
Right.
So how many locations now?
17.
17. It's one of my favorite. It's one of my favorite like semi-fast food. No, it's not like fast food because you sit down and
Yeah, it's fast casual. You order at the
fast
counter
casual,
and they deliver it to your table.
And it's my kids' favorite restaurant. Like it's, where do you guys want to go? Sauce or In-N-Out, like it's literally, except for my son who loves sushi and he'd go to Raw any day. But Sauce's is like second favorite place. And my daughter's between In-N-Out and Sauce.
Have you tried the chocolate chip cookie at Sauce?
I don't think I have.
Oh, you got to try it.
I love the bread that they give you with the butter.
Yeah,
oh,
it's all made fresh. Everything's made fresh.
Yeah, and the service is always awesome as well.
It's a great concept.
Yeah.
Yeah, it's a great concept.
Very cool.
A lot of value.
So, any more restaurants in the works for you guys, or
no? I'm not going to do any more restaurants. I have Morning Squeeze, Sauce.
Okay.
And then we sold all the restaurants I was involved with Sam in. So.
Morning Squeeze is just one location, though, right?
Two.
Okay.
And now we're opening a new one, a third one.
Okay.
Right at the base of the department. Do you know where the department is on First Street in Washington?
Yes, I do. In downtown.
We're on the ground floor there, on that hard corner.
So why not? Like, you seem very concrete about this. Why not any more restaurants?
I would open more Sauces and Morning Squeezes, just not more new concepts.
Gotcha. And that's painful because...
Well, you just don't know if it's going to work.
Right.
You're trying to figure it out all the time. When you have an
That's
existing
what you do, Todd. I mean, like, what are you talking about? That's like literally what entrepreneurs do. They don't know if it's going to work. We just talked about this, getting over the fear factor of it not working.
I always say I'm one panic attack from my ideal weight. So, I just need some more panic attacks to lose this COVID weight. Yeah, I do like the idea of coming up with new concepts, but it is very difficult to execute, and you really need the right people. Once you have an existing concept that's working, and
replicating that is easier.
That's more about operations and just real estate.
Right.
So I prefer to stick with Morning Squeeze and Sauce.
How has COVID affected Morning Squeeze and Sauce?
Sauce was down mid-single digits last year.
That's not bad.
So not horrible.
Wow.
To-go really boomed.
Okay.
And now in-dining's really picking up.
Speaking of to-go booming, did it boom direct, or is it all through DoorDash?
Both.
Okay,
they both went straight up. Yeah.
How timely for, like, you know how, like, people always have the conspiracy theories of, like, who created the virus because of who benefited?
Right.
They should be talking about DoorDash having created the virus, right? Because
Postmates, Uber Eats,
I mean,
DoorDash
has become like what, a $60 billion publicly traded company,
and it's an app.
And it's an app, which is absolutely insane.
It's an app.
It quadrupled after COVID,
right.
in actual revenues, which is mind blowing. Considering it was already on track to do like $1 billion or something, but it was going to do $4 billion last year.
Yeah.
But so do you guys fear, like, being in the restaurant business, do restaurants fear DoorDash and what DoorDash might do to their business? Like, if you go to order from Sauce, DoorDash says, hey, would you like to try this competitor for like 20% off or something like that? Does that worry you?
It's necessary. You have to be on these third-party delivery services. But
especially
you also,
after COVID.
Yeah, but you also try to build your own business, right?
Okay.
So we have our own in-house ordering at Sauce and Morning Squeeze. We have our in-house catering on both, even though we use Easy Catering too. So it's one of those things where you try to build your internal business, but you also have to use third-party business, because it's like, Amazon really doesn't sell a lot of their own stuff. They do, but they also sell a lot of other people's stuff. It's the same thing. It's like restaurants are going to sell their own stuff, but they're also going to have to sell other people's, that are reselling their product.
Yeah.
So,
no, Amazon is a perfect analogy, because once something does really good on Amazon, if it wasn't Amazon's product, they'll eventually make it their own product, right? Like it's fascinating. And I wonder if, at some point DoorDash's revenues are going to stagnant because every restaurant is using them, and it's like, what's next for them to grow? It's like
they might just do virtual kitchens.
Yeah, exactly, which has become popular because of COVID.
Right.
I mean, it's kind of interesting, all these opportunities that COVID has sort of brought to light that didn't used to exist, right?
Right. Yeah, there is a lot of opportunity, and those third-party apps have just come out of nowhere and really captured a big part of the restaurant market, and they're here to stay. Because I think people are a product of repetition and habit. And people are used to not cooking, not going to the grocery store, and they just, hey, what do you want tonight? And instead of calling Sauce or ordering directly from Sauce, you're just going to go on Grubhub or DoorDash and say, do you want this? Do you want that? I do it with my kids all the time.
Yeah.
And they're like, no, I don't want that. We had that a couple nights ago. No, I don't want that. And I just keep going down the list. And eventually I'll hit one. They're like, oh, I want that one.
Right.
You know, we did it last night. So, you know.
Yeah. It's unavoidable. I mean, it's so convenient that it's like, it's crazy. So you haven't invested locally, let's say, or in startups for the past couple of years because of the competition. What are you doing with your cash? Are you putting it in Dogecoin or like?
Yeah. You know, it's funny. A lot of people that I know that trade cryptos, they were telling me, oh, Elon Musk is doing a Super Bowl commercial for Dogecoin. I'm like, really? Are you sure? No. And I'm like, yeah. They're like, no, we heard about it. It's it's happening. It's underground, but it's happening. I'm like, okay.
Are these
of course, it never happened.
Group? Yeah.
You know?
Same group thinks March 4th Trump is coming back, right? Like,
and that's how you know you're at a bubble. I don't know if you remember this, but when Vitrix was public, you know, we had a market cap of over $100 million
for one day.
Yeah, and the message, it was over 70 for a while.
Yeah.
And the message boards were all like, Microsoft's making an offer.
Right.
You know, like, it's like when there's euphoria and greed and a bubble, crazy stuff happens.
Yeah.
You know, now I'm getting calls from buddies in college that know nothing about the stock market.
Yep.
And they're buying the most sophisticated biotech stocks that I've ever heard of when I start researching it. I'm like, how could you possibly understand what this company does?
With like $50 billion valuations and like zero revenue. Yeah.
And they're like telling me about it. And the more they tell me about it, the more I want to go out and short it.
Right.
You know, and they're like putting all their money into it.
Yeah.
And I'm like, this reminds me of 1999 when NetTime or Vitrix had that $100 million market cap. We didn't have $1 million in revenue.
Right.
And everyone's saying they're going to get bought by Amazon or Microsoft. And it's like the same thing's going on. Every day it's a story on who's buying this company.
And it's become so organized to create these hypes. Like GameStop was a perfect example of that. But what's funny is that it's happening to even real companies to where like everything is so overvalued, but largely because there's so much money being pumped into the market, right? I mean, it's sort of like a Ponzi scheme a little bit where everybody sort of sees the ups and downs, but it's all based on supply and demand, right? Like the prices are, can you hype it to where you can increase the demand for something, to be greater than the supply of it, and the prices go up naturally, right? Like,
yeah, I've seen a lot of bubbles in my day, and this is definitely a bubble.
Yeah.
But it could go on for another year.
Yeah, that's the thing that
2 years.
Also learned, that you cannot time the bubble.
You can't time them.
To sell short, for example.
Right. Well, I always say your best short sale is not your first one for sure. That's my experience. It's probably your third or fourth one. You know? So I only short 20% of a position to start with, knowing that I'm going to have 3 or 4 more times to bite the apple at a much higher price.
Right. You know? Now, do you short like uncovered, meaning like with
naked,
like naked? Yeah. So your upside risk is pretty tremendous, unlimited. So I in '99 time frame, I think 2000, whenever it was that like AOL and Time Warner had merged, and they had like a $300 billion market cap. And I was like, this company is so stupid. I mean, they still sold dial-up, basically, is like the core
Sending
business.
You the desk.
Yeah. And I was like, there's no way AOL is going to do well. And I remember buying put options, which at least limits, the amount of money you can lose to 100% of it, which I'm more comfortable with 100% potential loss. But I kept buying those put options month after month, and I watched AOL's price go from like $300 billion in market cap to like $600 billion. And I was like, I guess I was wrong, like I guess I don't know anything. And of course, it took another 3-4 years before it truly crashed, or maybe it was a couple years after, because after the dot-com bust, AOL also went down, and then it just kept going down and kept going down, and it went all the way down to like $4 billion market cap a few years later. But that taught me that I don't know jack shit about timing. Like right now, I think the stock market is overvalued, but I would almost be willing to bet that it's going to go up for another year before we see any kind of a correction.
Well, you have so much liquidity,
right?
And the government is just and the Federal Reserve are just putting so much capital out there, so
another
much money.
$2 trillion coming.
Yeah, I mean M2, M3, the money supply indexes are. I mean, you just watch the money supply, and it's just going straight up.
Right.
And so there's a lot of money out there, and there's no yield, and they're forcing you to take risk.
Right.
Because there's no yield out there, so you got to take risk to earn a return. And when that happens, everybody, the herd mentality, everyone rushes in.
Right.
I just like Warren Buffett's famous quote, when people are greedy, be fearful. When people are fearful, be greedy.
Yeah, I love that quote.
And I live by that quote, and I'm being very fearful now.
Yeah.
I mean, I'm in the market. I'm 90% long, 10% short.
Right.
But I tell you, I've had some longs go from 2 to 40 in 6 months.
Right.
I mean, I can't hold that stock.
Yeah. And what's funny is that people are more likely to buy that stock. I mean, I don't know what stock it is, but whatever it is, if it's gone from 2 to 40, they're more likely to buy it at 40, and you'd have to twist their arm to buy it at 2 when it was like a value stock, right? Like, you'd be like, this is a great stock. And I couldn't convince anyone to buy Tesla 2 years ago. Today, everyone wants to buy Tesla. And it's like, are you kidding me? It's 15 times.
It's $1 trillion company.
Yeah, it's $1 trillion. Like, it doesn't do 15 times more sales, by the way, than it did 2 years ago. It's barely 50% more sales.
My dad is the perfect barometer. My dad's 83, and I manage a lot of his stock portfolio. And he calls me all the time when he's down 50% or more in a position. He calls me all the time. Todd, you should sell that. You should sell it. Just sell it. It's going to go to zero. Sell it. We're down 50%. Just get out. And when he's doubled his money in a position, he's like, why didn't you buy more? Let's buy more.
Yeah.
So it's like the opposite of what I want to do.
Right. When it goes down, I buy more.
Right.
Because it's like, well, I believed in this company. Has anything changed? No.
Right.
If nothing has changed, buy more. You know, like it's sale price, essentially. But
yeah, so that's the contrarian methodology and system. And a lot of people are momentum people.
Right.
They feel good when things are going up and they want to buy more.
Right.
It's that greed factor. And when things are going down and fear sets in and those chemicals get released, guess what? They want to sell, get out. Take your money, run.
Yeah, no, and when that happens, it might get pretty ugly. I mean, like each one of these cycles, whether it's like the housing bust or the dot-com bust, we see unprecedented downs as well. Like housing had never gone down like 70, 80% in some markets, and it did. Like it was unprecedented, right? Like, and the stock market could easily do something like that,
Yeah.
But yeah, it's so. Let me ask you another thing, because we kind of touched on Dogecoin, which is sort of a joke meme thing. But Bitcoin, what are your thoughts about Bitcoin?
I remember when Bitcoin first started trading, and I read an interview with Mark Andreessen, and I was fascinated on how much he bought into it. And this is years ago. I'm like, because this is a really smart guy, who's really hit it out of the ballpark as a founder and as a venture capitalist. And I'm like, he has some really important points and valid points that probably at some point will come true. So for me, it's like it's a question of timing. It's when banks, the governments, major companies start recognizing Bitcoin as a real acceptable currency with a backer behind it. And the more Tesla starts accepting Bitcoin, and the more Overstock and all these real companies out there start accepting it as payment and get behind it, I think it becomes real. So, where it trades, I don't know how that all works. That's supply and demand. And I think you have so many momentum traders out there that I don't know what fair value is, but I think as a real currency that's going to be in the market, it's here for sure.
Right.
Like Bitcoin is definitely not going away.
Yeah.
Is it go down to 20,000 first before it goes back to 60,000? I don't know.
Right. No, I mean, nobody knows that. But what's funny is that when I first learned about Bitcoin as a currency, I always thought it was kind of a silly idea, because you can't price things in a currency that fluctuates by as much as 40, 50% in a day, right? Like your price has to be like, this moment the price is 1 Bitcoin, but the next moment it might be 1.4 or 1.2 or 0.9. Like you just can't price things. So, one of the things that triggered or clicked for me is to think of Bitcoin as more like a digital version of gold. And I was like, okay, so as a gold replacement, it's kind of an interesting idea because it sort of has similar properties in that it has value universally, meaning like the entire world. You can convert Bitcoin to cash in any currency anywhere in the world. But it has these additional properties of where you can like send it to anyone in the world as well. Whereas gold, you can't really do that. And it has zero weight. So it's sort of an interesting sort of backup solution for people or for countries that might be like having their currencies go down or inflation happening in significant ways, like in, I don't know, Venezuela or Iran or like all these sort of countries that have all kinds of problems with their own currency. Their people can convert to Bitcoin as a way of protecting themselves in a way.
Right. Yeah, I think Bitcoin, I think it got really popular because it was accepted and it was untraceable. Right? You couldn't really trace who was sending it, where it came from. So it probably got used in a lot of areas for illegal purposes, but then it started to get endorsed by real companies. So I think it's one of those currencies that'll be here, and we'll probably we'll all be using Bitcoin at some point, just like I use PayPal and Square all the time, or Venmo. There'll be my Bitcoin will be just another option.
Okay.
Right. It's just.
Do you think it'll be that?
Eventually, yeah,
like
for
common.
Sure. Yeah, and it'll start. I think the fluctuations and the volatility will eventually settle down. The more people that start getting involved in it,
Well, see, that it seems like the more people that get involved in it, the higher the price and therefore volatility will go, right?
Most people are involved on a trading speculation level.
Okay.
When I mean more people getting involved, I mean more people actually using it for purchasing goods and services.
Okay. For transactions.
Yeah, for transactions. And because right now it's just a speculative, currency.
Right.
It's just a vehicle. It's an investment vehicle. But I think once people actually start using it as just a dollar, or
But if in order for that to happen, in order for people to use it as sort of like the currency that I pay you or someone else with, there has to be a lot more people purchasing Bitcoin,
right.
And that's going to cause an even more of a price spike, right? Because there's limited supply of Bitcoin. Like
right.
Currently it's 18 point something million. Eventually there will never be more than 21 million. So and a lot of people, like let's say Tesla keeps 5-6% of its cash in Bitcoin, and other companies start to join in. They're sort of taking out the supply. I don't know how many Bitcoins $1.5 billion comes out to, but that much just got taken out of supply unless Tesla decides to sell it again. So I think that's why you see this like massive price increases as well, because there's now less supply to transact with.
Yeah, and I think most of the people that own Bitcoin today are using it for speculation. But there'll be a point where it'll be less speculation, more of usage of it, as spending money, spending Bitcoin.
Okay.
But
so you don't have your money in Dogecoin. Do you have some Bitcoin?
No, I have zero cryptocurrencies.
Zero.
And my kids are always asking me why.
Okay. So your cash is mostly in the market, but even though you feel like it is kind of overvalued, you might be shorting some things.
Yeah, I think most areas are overvalued. I think real estate, I think high yield debt is overvalued. I think definitely the growth momentum stocks are overvalued. Emerging markets probably not as overvalued, but you have a lot of political, governmental, and currency risk there. But I don't know. But you also don't get paid to hold cash.
Right.
There's no interest rate on no returns on money markets.
Right.
So it's like, again, everyone's getting forced into taking risk when they don't want to. I mean, do you know how many hedge funds and mutual funds are buying stocks they don't want to really be buying right now, but they're buying them because they are forced to buy them? That's
because
happening all the time.
0% interest, essentially, right? Like you can't just leave your cash laying around. But
so they're being forced to buy stocks, and it just creates that herd mentality.
Right.
But at the end of the day, when the music stops, there's only a certain number of chairs for people to sit down, and not everyone's going to get out.
Right.
The professionals will probably get out first, and then retail will be left holding the bag, just like in 1999, 2000 timeframe, and then again 2009 and 10.
Yeah.
I had a lot of friends sold all their stocks in 2010 and 9 after like March of 2009 to
when they should have been buying.
And I kept asking why these stocks are trading at cash.
Right.
Great software companies were
Right.
trading at cash.
I remember that. I mean, it was just unbelievable.
I'm like,
could
you
buy
should be
Microsoft
mortgaging
at
your
$12
house.
a share.
I bought some at 30, I remember. And I'm like, you should be mortgaging your house, your car, borrowing money from everyone you know
Right.
to be buying these. Oh, no, they're down 80%. It's going out of business.
Right.
I'm like, all right. And the opposite obviously is true today. But there'll be another time where everyone sells.
And that's when you're going to get back in.
Yeah, and you never get back in early. You got to
Right.
let it breathe for a while and
Yeah.
let the technicals kind of run its course. But I think 2000. I remember from December of 1999 to March of 2000, there was such a run up in stocks.
Right.
But then March was the peak.
Yeah.
And I think NASDAQ hit 5,000, right?
Yeah.
In March of 2000.
2000. And it's still not 5,000 yet, right? Like, or did it just recently?
No, it's double that now.
Is it okay?
Yeah,
I know it did it within the last 4 or 5 years. I feel like it finally
exactly.
recovered from the 2000 low.
Yeah, it kind of blew through that, which just shows you we're at a bubble. I mean, it went down to 1,000 or less, and then it went back to 5,000 in the last 4 years.
Right.
And now it's like just gone straight up, parabolic, basically.
Yeah.
In the last few years, but again, it's like
It is crazy.
Someone's got to pay. The government's in $23 trillion in debt and going up every second. So at some point, it's like, wait a minute, someone's got to pay for this 30, 40, 50 trillion dollars in debt.
This is something I don't understand. Like, it's funny because I was listening to an economist just the other day on a podcast, and he was saying that most people think of the government debt as similar to their own financial debt. Like, like if you are not balancing your checkbook or if you owe way more than your income or whatever. And you can't think of government debt in that way. And I was like, okay, well, then in what way can you possibly think about it? Right now, it's 5 times our annual budget, right? Like the United States annual budget is somewhere around $4 to $5 trillion, and we have $23 trillion in debt. We're about to get into another $2 trillion. So, in what way are we supposed to think about it? How high is too high? And
well, the rationale is you can always grow out of it, and we're the taxing authority, right?
Right.
So it's like we can kind of create our own destiny. But I think you're almost at the point of no return where you can't increase taxes to the point where you have diminishing revenue,
right?
And then you can't, you can't keep printing money because at some point people are going to lose confidence in buying your debt, your treasury notes and bills and bonds. So, right now most of the treasury purchases are from other countries, and when those countries stop buying, the Middle East, the sovereign wealth funds, the government of Japan and China and all these companies, and a lot of them use it as a hedge. But when they stop and rates start going up, because when no one buys your debt, what happens? Rates go up so you can eventually sell it.
Right.
And that's kind of what happened in the 70s under Carter. Rates started going way up because people weren't buying the debt, but you didn't have inflation.
Right.
So you had what's called stagflation, and it's
So these are some of the things that the economics things that's sort of over my head, because my understanding is that even Japan and like most European countries and like other countries are also spending more than their annual income. So how could they be buying our debt? So like lots of potential issues there. I don't want to get into that stuff right now, though. But let me ask you this. Let's switch the topic a little bit to Arizona and investment in Arizona. As I hope you saw the announcement that I plan on investing in the startup market.
I put
locally.
a big smile on my face.
That's awesome. Are you going to invest with me, by the way?
Absolutely.
All right, that's awesome.
Absolutely. I mean, I always say the only way to get a seat at the table is to write a check.
Yeah, awesome. Awesome. So the question is, what do you think would be a good strategy for me to pursue in this way? Like, I know going into it that the vast majority of startups fail, right? So there's going to be a lot of checks written that's going to become worthless. But what do you think the strategy should be to sort of try to maximize the hits? Is it like just finding the good founders and then sort of fine-tuning what the products should be? Or like, what are your thoughts around? What advice do you have for me?
Yeah, and again, I don't invest in pre-revenue too often. I do once in a while. I actually just invested in it's not pre-revenue, but it's like $6,000 a month
Okay.
in revenue. So to me, that's like almost pre-revenue.
Right.
I just wrote a check for that because he worked for me before, and he's a friend, and I trust him. But what made me write that check, though, was one thing, and that is the chairman of the board and his coach is Paul Winandy, who was the CEO of WebPT.
Okay.
And I have a lot of respect for. He took it from 600,000 of revenue to 60 million, right?
Okay, wow.
With very little capital.
Yeah.
So I have a lot of respect for who Paul is as a leader and CEO. So when Paul said he's invested a lot of his personal money in this business and he made a commitment to become executive chairman and coach the two founders, that got my attention.
Okay.
Because I think if you have someone who's seasoned like you or Paul or Heidi or somebody who has already done it and been through a lot of the peaks and valleys in a startup, you can help somebody who's going through it for the first time.
Okay.
Because a lot of times startups fail, like you said, and a high percentage of them do fail.
Yeah.
But I think they fail less when you have a coach or mentor around you that could help guide them through the emotions and the hard times.
Yeah.
Yeah. And they don't freak out and make irrational decisions and emotional decisions. And, just having a sounding board and a coach with you, I think improves your success rate.
What do you think Arizona needs? Like, what are the things that we fall short on as a community, as a startup community in tech specifically, to really level up?
Well, it's things like I just talked about. It's that coach, which San Francisco and Colorado and Atlanta now and Dallas, they have Y Combinator, right?
Right.
We talked about getting one here and it never really happened. But,
Yeah.
The Y Combinators, the Techstars, like those are programs that improve the chances of success.
Yeah.
Period.
Startup AZ is doing, I don't know if you've looked at what Startup AZ is doing with Brandon as the head of it, but they put together sort of these groups of founders that they meet regularly, like every month, so that the founders can talk to one another and have structured meetings where they can be supportive or review each other's marketing plans and things of that nature. They're doing some cool stuff. Have you seen that?
No, but that's what we need.
Yeah.
That kind of stuff.
And it's a nonprofit, so I'm happy to be supporting them and potentially do a lot more there. But that's another venue that I think it's a hole that we had before Startup AZ, and people like Mario and others stepped up to create that. I think even Brad from WebPT has been a part of it as well.
Wait, what's it called?
Startup AZ.
Oh, yeah, I have heard of it.
Yeah.
Yeah, because Mike Kovrick is part of it,
Okay.
our founder and CEO at Attrabytes.
Yeah.
That we just sold. And he was telling me all about it. So, yes, I do know about it.
Yeah.
And I think it's incredibly valuable. And Mike thought it was very valuable for him personally and for Attrabytes.
Yeah. I think, like there's a lot of things that founders go through or entrepreneurs in general go through that only other founders can understand.
Right.
They're sort of like pain, the various different challenges. Bob and I were talking about due diligence as a potential pain that we both went through in the past year. And it's kind of a weird thing. You can't really talk about due diligence with anyone other than a founder who's or like a seller of a company who's gone through it.
Yeah, that's great. Then that is needed.
Right.
That's needed. Obviously, capital is needed. Coaching is needed. Fellowship and community within other startup like that. So there's a lot of chemistry that needs to happen. And a lot of the bigger cities have it. New York for sure, San Francisco, Austin. But Phoenix needs more of that, I think. I mean, you have like Visage executive forums, which is great. Big believer in that stuff. But founders can't go it alone, and a lot of them think they can.
Right.
A lot of them like, I don't need a board right now. I don't need a coach right now. I mean, I can't tell you how many times I've heard that.
Yeah.
And guess what? Then they start calling you with these questions. You're like, well, I told you to get a coach. I told you to join an executive forum. I told you to join, some group. And now, eventually they need it.
Yeah.
It's like, I don't need therapy. And then eventually you're like, oh, I'm really feeling anxious and worried and depressed. Well, you should have got therapy.
Yeah.
So,
That's funny.
It's just, until you go through it. But even the best founders that have done it twice, 3 times, 4 times, they always want smart people around them when they coaches.
Yeah.
And I just talked to I had breakfast with a founder CEO yesterday. He's extremely successful from the Valley. His company's called Cubics.
Okay.
Anton. So I met him yesterday, and he was bragging about his coach and his mentor in his company, and it came from his investor.
Okay.
And the guy just passed away unexpectedly this last few months. 68 years old, very healthy, and he was like at such a loss from this guy because he developed this personal relationship with him, and he became a good friend, and he trusted him, and he opened up to him, and he was like a family member, you know. So when the guy passed away, he felt this huge void and hole. But you know, what I took away from it is this guy really helped him. He helped him grow as a person, as a CEO, as a business, you know. And he says he couldn't have done it without that guy.
Right, right.
But going into it, he's like, all right, I'll please the investor. I'll just do it.
I'll go meet with him.
I'll go meet with him.
Yeah.
And then years later, and he grew a very big business, he's like, wow, this guy really had an impact.
Yeah.
You know?
That's awesome.
Yeah.
It's been so much fun talking and catching up with you, Todd. I mean, like, first of all, we should probably do this regularly.
I would love to.
Yeah. It's funny how much we think alike. I mean, we have, stayed connected in the past 20 some odd years, but like not as much as perhaps we should have. And it's surprising how much you think, like, you know, from an investment perspective, we have similar sort of ideas. And we both think that the market, we've seen this before. The market is way overvalued, and the dot-com bubble, we went through it together where we had a company worth almost $100 million for a day, which was fascinating.
Sell.
We were all locked up, of course, but
nobody would have bought it.
Yeah. Is there anything you wanted to talk about that we haven't touched on yet that you think would be a good way to sort of end the segment or end the podcast today?
You know, I think there's things that I know ASU talked a little bit about, and I taught a class at ASU, an elective class at ASU, and we named the class Shark Tank.
Oh.
And we actually created groups, and we had people do Shark Tank pitches.
Okay.
You know, I think starting the dialogue earlier with college students or first-time entrepreneurs, like even at the Coplex level, when they have an idea, of just trying to teach them some of the basics that you and I maybe take for granted now.
Right.
But they don't know. Like, what is a pitch deck? What are KPIs? And just start trying to bring some of that.
Yes.
Because the stuff we're talking about is maybe even more advanced for some of the people that are thinking about starting a business.
Yeah. Yeah.
Like, I just met with a guy before I came here. That's why I was a few minutes late, who is starting a business. He's a general manager of a car dealership.
Okay.
And he's 24 years old. And he actually has a brilliant idea for a business, but he has no idea how to even go about it.
Right.
He knows the idea is going to work because his dealership would go out and sell it.
Right.
But he doesn't know, okay, what's a business plan? I do an LLC or a corporation? Like, just some of the basics that we take for granted when we start a business. Like, he doesn't even know how to do that.
Yeah.
So, you know, maybe start some introductory courses.
Even the paperwork to take on an investor is pretty significant, you know, like, and quite costly, right? The legal costs are like 10 grand to just get the paperwork together.
For sure.
We need to address some of those things as well. Yeah,
because the earlier you start helping these folks, the more that's going to permeate into real businesses, you know.
Yeah. Awesome. I'm excited to be doing that stuff. I hope, you know, it sounds like you're ready to join me. I mean, you have been doing it, first of all. Let's just be clear. You're the guy who's been doing it for the past 20-some years. Huge kudos to you. Congratulations for the successes that you've had. And I look forward to joining you, essentially, and working together so that I can hopefully bring you to be risk tolerant enough to write those small checks that even if you lose them, it's not a big deal. It's not going to change your lunch.
Well, thank you. And thank you for everything you do for the community, and congratulations on your exits and
thank you.
You know, all your success. And it does warm my heart that I've known you when you were still just getting started, you know.
I appreciate that. Thank you very much, Todd.
Thank you, Hamid.
Bye.